Hello everybody. So today we are going to do a few problems on short selling of stocks and also on the rights issue. So the first problem, pretty simple, straightforward problem. Suppose there is a person who sells short 200 shares of Golconda Gems at the price rupees 80 per share, and it is expected that by the year end the price will fall to rupees 65, right? We are also given that margin is 70% on the gross sale value. The dividend on the stock is 1.25 rupees per share for 1 year, and the brokerage costs are 1% of the transaction value. So first of all, we are asked to calculate the percentage loss or gain on the invested capital if the short selling is covered uh, at rupees 65 per share, right? So this particular problem is pretty simple. First, you have to calculate the invested capital, which is margin, which is given as 70% times the value of the sale, right? Which comes to 11,200. And when you are selling this stock at rupees 65, so how much you gain? 80 minus 65. There is a quantity of 200, so that becomes 50 times 200. That is 3,000 is your gross gain out of this deal. Now, how much brokerage you have to pay? There are two transactions. First, you are short selling, then you are covering. So both of them 1% of the total sale value, and that becomes 290 rupees. 160 plus 130, 290 rupees. Now, how much dividend needs to be paid for that? 1.25 into 200, right? 250 as a dividend was a loss of the broker, which you have to make good by paying to him. So the net gain is gross gain minus brokerage minus dividend that you have to pay to the broker, and 2460 is finally what you get in your hand, which is a gain on an investment of 11,200. So finally this comes out to be 21.96% gain. The second problem is asking that suppose the share price becomes 70. Now how much is the margin? So the formula is given here in orange, as you can see here, right? So what is the formula? Sales proceeds plus equity deposit. You have to divide by the value of the security and subtract 1 from that. So how much is the sales proceed? 80 into 200, 60,000, that we have done earlier also. You have deposited 70% of that. That means 11,200 has been deposited, right? But the share price is if you want to calculate the margin, right? So at 70, what happens? The value of the security is 200 into 70, which is 14,000, but your deposited amount is still 11,200 with the broker. So your margin naturally goes up. So this margin is sales proceed. That is how much is the money that you got after selling those stocks at rupees 80. You got 16,000 plus whatever you have deposited with the broker divided by 14,000, right? Since the denominator goes small as the share price falls, so your margin keeps on increasing, and the margin here is 94.28% as we calculated here. Suppose instead of share price falling, which was the main purpose of short selling, the investor is unlucky and the share price goes to 120. What happens then? Your denominator, which is the value of securities, now becomes 120 times 200, and your numerator remains the same, 16,000 plus 11,200, which is sales proceeds plus the equity deposit. When you do -1 and multiply by 100, your margin, which was earlier like 70%, has shrunk to only 13%, right? So when your margin drops below, say 30% or something, your broker will be worried, and he will ask you to make good this drop in margin, right? Now this is something known as maintenance margin level, right? So this is below maintenance margin level, and now broker will give you a margin call. So what is margin call? uh, you know so suppose maintenance margin is given as 30%, then what is the price which will maintain that particular margin? So that will be calculated as 27,200. What is 27,200? 16,000 plus 11,200, the sales proceed plus the equity deposit divided by the quantity of the shares into the price minus 1, that should be 0.3. So if you solve it for P, you get 104.61. So if the share price crosses, it goes beyond, it goes up, it becomes more than 104.61, you will get a margin call, right? The third question is also simple. Suppose somebody bought 100 shares at rupees 25. After 10 months, the price becomes 75. So how much is the unrealized gain? And she has not yet sold them. So 100 becomes 75. Sorry, to 100 shares bought at 25 become 75. So that means you gain 50 rupees per share. There are 100 shares. So unrealized gain is 5,000. You don't sell. Maybe you want to save up on short-term capital gain tax because it's only 10 months now, or maybe you are afraid that share price may go down if you know but you are at the same time you are afraid the share price instead of going up now may go down, so you want to kind of insure yourself. What is a hedging strategy that we can make here to protect my unrealized profit? So this is a beautiful question. So we have now two transactions. One is long, we have to do a long transaction, right? Which means that unrealized gain of 5,000. Another is short. Okay. Suppose there is strategy of selling 100 shares of the same stock. That means which are sold at 7,500 because the price has become 75 now, and the price fluctuates as follows. So it is given here. Look at this table. So suppose the price is now 75. We bought it at 25. So long profit is given by say 75 minus 25 into 100, because 100 shares were there, 5,000 was a profit, and this is something which we want to protect also. Now suppose you are doing a short transaction also at the same time. Okay. So when you are doing a short transaction at 75, you short sale 100 shares. uh, uh, what will happen? You don't gain or lose anything, right? Because if you are having an unrealized gain of say 5,000, so that you want to protect. Now suppose the share price declines to 65. What happens in your long transaction? That means at 65 you sold whatever quantity you had, 100, but you also did a short transaction. You also did a short transaction. That means you whatever short selling you have done of those shares for 7,500 rupees, now you buy them at 65, right? So you are pocketing 1,000 rupees as your short transaction. As your long transaction, uh, when you sell those 100 shares at the market price of 65, you get 4,000. So your total money is protected, say 5,000. But there is a brokerage involved here. How many brokerages? First one, when you did the initially short selling of 100 shares, then this second brokerage when you do a long selling, and a third brokerage when you do when you cover up your short sold shares, right? Suppose the share price falls to 45. So you can sell all those shares at rupees 45. You bought them at 25. So you pocket 2,000 rupees. And you also get from short selling, gain of rupees 30 per share, which becomes 3,000. So ultimately you are able to protect your 5,000. Similarly, even if the share price falls to 25, you are able to club your long and short strategies, and you are able to hedge yourself. Okay. So the mantra is sell short at 75, then as price declines, close the deal and you gain. This is called short sale against the box. I repeat, this is called short sale against the box. This is the first of the hedging strategy. Okay, a technique of combining transactions so as to try to achieve uh, a position of reduced risk. Okay, a technique of combining transactions so as to try to achieve a position of reduced risk. Okay, We'll see more strategies in options in future. But what is the drawback of this long and short strategy? The drawback is, so the concern was that price may go down, but instead of going down from 75 to say 45 or 25, it goes up to 100. Then what? Then you start gaining on the long transaction, but start losing on your short transaction, right? But you protect your 5,000 still, but the problem is you have to forego the additional gain, that you would have realized much more if the share price had become 100. Okay, now another problem that, 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 the total share